Okay, folks, welcome to Volume 7 in the continuing series of the Market Maker Collection. We're going to be focusing on the ICT cell model here, and it's going to be pretty much a mirror image of everything that was described in the previous installment, Volume 6, where we discussed the ICT buy model. And you're going to see that while many of you have really made it much harder for a concept to be absorbed than it needed to be, there is an overlapping between both the sell and buy model. And it's because the pattern is a fractal. And fractals move inside one another, they inhabit one another, they reside in one another. And where one market profile ends, another one begins. And even where that transition takes place in a larger scope of that section of price action, you actually see, in other words, inside of a buy model, there may be a sell and a buy model in smaller time frames. Okay, but overall, between those three overall fractal patterns, they make up the larger one. So it's important that you understand that we're really basing this entire premise on the inherent nature for price action to be fractal in a generic term. But many times it's been tossed about by mentors and even myself. I'm guilty of this as well. That we rather mention it glibly that fractals are easy to see. Well, without really breaking down a market or a sample set of price action, it's really hard for one to come away with an understanding of what is deemed a fractal. Um, every single time I've come in contact with a mentor or an author or someone that refers to fractals in price action, I'm quick to ask them, what is a fractal to you? I ask this of you know of people that will ask me in an email, is this a fractal that you would go long in? Well, I ask them all the time, what is a fractal to you? Because just because there is a label applied to it by someone else doesn't necessarily mean that that is the same thing that we all see. Okay, and I'll give you an example of that. If we look at a head and shoulders pattern, classic price action, okay, a head and shoulders pattern in early stages of trading may not be so clear to one another. Okay, we could all look at a chart. If we all simply went back to the very beginning day of us looking at a price chart and we looked at a head and shoulders price pattern, if every one of us had the same example placed in front of us, it goes without saying not all of us would have identified that as a head and shoulders, even if we were conceptually shared the general idea what a head and shoulders pattern is. And it's simply because we haven't warmed up to the the discovery of what it looks like and understanding what it looks like and how does it become evident in price action. Because without the understanding of how that takes place, talking about these things conceptually, and whether it be you know broad brushed and vague as we have here in a very conceptualized manner in this ideal depiction as I see a fractal, um, it won't make any sense to us if we don't have a framework to build upon. And that's what we're doing here in volume 6 and volume 7, to give you an idea on how I see price action, how I view price action. Because no matter what you uh, look at the market in, whether it be 5 minute, 1 minute, hourly, weekly, monthly, doesn't matter the the time frame at which you're looking at price. It's the manner at which you're looking at price. Okay, because if we can uniquely remove all of the distractions and just get to the core of what is price action doing right now based on what it has done most recently, and if we can have a higher time frame premise in addition to that, it moves along the odds of our being successful in an exponential fashion. So without all that preamble, let's get right into this one. We look at the buy model, okay, and I'm assuming you probably just watched that video. So if you're looking at this, you'll see this is pretty much the mirror image of what we disclosed in the buy model. The initial consolidation, okay, um, this is where orders are accumulated. And I know most of you will probably assume that this should say distribution to accumulation, and that's not the case. Okay, the markets are always predisposed to be sellers. Okay, so they're going to sell, 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 and by selling, they are accumulating. And I know that's hard for some of you to grasp, but you got to look at it from an institutional side. You're accumulating orders by being the storehouse or the seller. Okay, none of us can buy British pounds without there, yes, being a supply house or or a central bank that um, prints that particular currency. They have to accumulate always. Now, by their accumulation, the way they will offset their risk, okay, or reduce their risk, manage their risk, or profit, they will distribute. Okay, so it's important to understand that the central banks are in business to, yes, provide liquidity, but they're also a business. They're not just simply there to give everyone free opportunities to make money. Okay, so the initial consolidation in here is an accumulation phase. The market will move into the run to resistance. Okay, and then the next stage is the smart money reversal. Okay, so any longs that they would have accumulated in here or hedged on a larger time frame position, maybe this is um, a short bear market, and they would have accumulated some long positions to hedge during a anticipated move higher that would set up a longer term additional selling point where they could get more short positions in the marketplace for their longer term trade lower. So they could accumulate longs in here to do what? To hedge their short position, okay? And they'll reaccumulate in here and buy more, and it'll run to a level of resistance, and then they will distribute what they had hedged back here, okay? And by going short in here, as the market starts to break down, the next level is the distribution for the low risk sell. This is where it's clearly seen many times by a lot of guys in my camp where they'll see the optimal trade entry. Okay, market structure will break up here, then they can classically see the ICT optimal trade entry, 62 to 79% retracement level, or what we dub classically the 70.5 fib retracement level into a previous order block, and then it would get short. The next stage is either a redistribution, okay, or in other words, an increase of more selling orders or short orders, or like we had in the previous teaching about the ICT buy model, this stage here can be a reaccumulation point. Okay, in other words, this could be a buy, a retracement here, just to reaccumulate more longs that they had accumulate here or in here. Okay, so in this area here, we could see the resumption of a longer term bull trend, okay, or